Paul, let's go over the basics a little bit because this is kind of a very different vendor relationship than some of the others the association might have. Starting kind of with the most basic question, though, this was kind of a common one. What insurance must the association carry, and is there a self-insurance option?
So let me address the first part of that question. There are a handful of insurance policies that an association needs to carry. Most commonly is a property insurance policy. So we're covering the buildings for a condominium association. In the case of an HOA, they could be other type of improvements, clubhouses and auxiliary property. So that's a very common policy that we see. A general liability policy. General liability covers the premises from hazards like slip and fall. So that is another policy that associations need to carry. A directors and officers insurance policy is very important to have because it's basically management malpractice coverage, and it covers decisions made by the board and the management company. Finally, there's a crime policy or a fidelity policy, and that covers the association funds that sit in bank accounts, and they could be stolen by a whole variety of sources, outside people, and it covers the funds that the association is holding on behalf of the members. Also, an umbrella policy is really important to have because the director's insurance policy and the slip and fall policy generally limits end at $1 million. And that's just not enough in today's world. So we buy an umbrella policy that covers over and above when the policies are exhausted. So those are the common policies, the basic policies that we see in almost every single association's portfolio of policies. And then regards to the second question, can they be self-insured? And this comes up a lot. So years back, there was a self-insurance trust that was created. That was the closest thing to real self-insurance, and it really wasn't self-insurance. Self-insurance in itself is a thing. So there's funding for it. There's excess insurance over a certain amount that an association would buy, and it's just not practical for several reasons. Most commonly is anybody that is buying a unit inside a condominium association that is getting a loan from the lender is going to require it that the association have insurance from an insurance company that's licensed and approved. So that's the most common reason why it doesn't work. And the other reason it doesn't work is just because we're exposed to catastrophic risk here in South Florida, and whenever there is exposure to catastrophic risk and the frequency is high, self-insurance usually just is not a good option.
Right. So we know they have to buy insurance. They have to go to the insurance market. So what is the role of the insurance agent? What is your role in this process?
The insurance agent has a very important role because even insurance companies that sell insurance directly, they have to have a licensed insurance agent to sell it. So it's very important that the insurance agent that you're dealing with understands community associations, because the agent is the conduit to the insurance companies. So the role of an insurance agent is to seek out the best insurance companies that can that can provide the coverages. And agents like me are independent, so we're not tied to any one particular company. So we can go out and cover a variety of markets. And in Florida, the market is fairly limited. And it's important that the insurance agent that the community has engaged has a good understanding and has the connections with the correct companies that can get the policies effectively placed. And also an agent's role is advice and counsel. So, with rates going up and things happening, you need to know that you can count on your agent to give you some good, solid advice on how to get the best deal you possibly can.
So how does the association shop its insurance or bid out its insurance? Does it Change its agent, or how does that work?
Yeah, this is kind of a lot of confusion what happens here, because like you started saying that the relationship with an insurance agent is very different than other vendors. And once a community has an understanding as to how this works, they're going to be in a better position to be able to negotiate. So oftentimes communities think, hey, let's go talk to 10 agents because we're going to get 10 bids from agents. And that's not the way it works, because the insurance companies will only talk to one agent at a time. So because in Florida, there's a really limited number of companies that will write. I mean, there's lots of companies that write, but most of them aren't going to be competitive for one reason or another. And it's really important that the agent have connections to those carriers, like I said, but they're only going to deal with one insurance agent at a time. So by engaging multiple agents, you're not getting multiple bids. And you need to sign what's called an agent of record letter. And basically, it's important that you have the right agent, because even though the company's rates are filed and they're only going to give one bid, the agent's role of negotiating that and the end result of what ends up the program that the association that ends up buying is highly impacted by the insurance agent.
So how does the association know they're getting the best deal if they're locked into one agent?
So that question is a great question, and you have to have trust in the agent that you're dealing with, because if you engage multiple agents and one agent is covering the marketplace, then you're not going to be able to engage multiple agents. So the key is to choose an agent that can do the job and that you can trust, and that's going to go to those markets. So an agent, when he or she presents his or her proposal to the association, should put a page in the proposal of all the companies that they've gone to and what those companies have quoted. So in transparency, the board can see what that agent has done on their behalf, and they can show the residents that there's been a diligence process and they haven't just relied on one person to give them one quote.
Right. And this is another common one in Florida. We already had someone in the Q&A bring this up. What is the difference between an admitted and non-admitted carrier? It's very unique to Florida.
Yes. Two big differences between admitted carriers and non-admitted carriers. The admitted carriers, all carriers are approved to do business in the state of Florida, where you shouldn't be doing business with them. But all carriers that we do business with are approved. But an admitted carrier has a higher degree of regulation. So the state has to approve their forms and their exclusions, and there's a little bit more consumer protection there. And then the other big item is admitted carriers participate in what's called FIGA, the Florida Insurance Guarantee Association. And if they go bankrupt, the state stands behind them, whereas non-admitted carriers are there to take more risky deals, and they don't participate in FIGA, and there is no backstop.
Gotcha. Now, does an association have to be with an admitted carrier?
No. An association doesn't have to be with an admitted carrier. And in the present market that we're in, a lot of times an association won't even get an option to go with an admitted carrier. So again, going back to the agent's role, it's really important that your agent is vetting these companies and making sure that the non-admitted carrier you're dealing with has a good, strong rating, and the association, the board, can ask questions about their rating and their ability to pay claims and their service and all those important factors.
Thanks, Paul. I think we've got the basics pretty well covered there.